One of the questions I got from someone is that they got a loan with a second-tier lender and they were concerned that basically this is like dangerous shark money, and as soon as they need to get away with it and get into a Big Four. So the question I've got for you, Aaron, is what's the difference between the Big Four, the second-tier lenders and the third tier, and is it more risky to be in one over the other or more dangerous, or how do you think about it?
Well, start with a statistic of what the Big Four have as market share in the home loan space. It's between 76 and 80% of the home loan space is taken up by the Big Four, and the Big Four being CBA, ANZ, National Australia Bank, and Westpac. And then those are the Big Four. And what's really interesting in the market of lending is that when we start thinking second tier or even third tier, guess where their funds come from?
Don't tell me the Big Four banks.
Oh, yeah.
How funny.
Of course.
So here's an interesting thing. I was talking to a non-bank lender that has 3 lines of products. So non-bank being second tier, so try to put it in in the words that came through in the question. Second tier being non-bank. And I've got 3 sets of products with this bank. So they've got what you would normally get at a Big Four, which they call prime lending. So that's full doc, full assessment, everything. Their warehouse for that line of funding comes from one of the Big Four. Then they've got this thing called the near prime. So the people that might need to use a different form of income verification. It could be business activity statements. It could be that you might have blemishes on your credit file. That's called near prime, and that's warehouses another Big Four. It's like a big credit card for them to be able to lend out money from another Big Four. And then they've got the specialist lending. This is the ones where you might be behind in your mortgage, credit impaired, not coping too well, and you need just a hand to get out of that, consolidate it together, and then go down the path of moving through to prime lending and then on to, if you want, Big Four or Tier 1, you could say. So that specialist line is another Big Four funding that. So it's really interesting. The Big Four do invest as a 76 to 80% of the market directly, but indirectly, there's funding lines with credit policies that help a whole range of other borrowers out there. So I would put it this way. $1 from a Big Four bank is the same value as $1 from a non-bank or second or third tier lender. It comes down to your situation. Is it more risky? I think when you categorize them as Tier 1 and Tier 2, people then go, one's bad, one's good.
Yes.
And it's not.
Yes. Yeah,
One's bad, one's good.
I'm nodding.
Well, I don't want to be Tier 2. Do you want to be Tier 2, Grant?
No, man, they're all shady. The reason they can't get into the Big Four is because they're shady, Charlie. Like, that's why they are.
Do you know, here's other banks' names. Do you think St. George or ING Bank or Me Bank or what other banks we got?
Don't put Me Bank in there.
Bank West. Do you think they're Tier 1?
No.
No, I do know who
2.
owns one of them.
Yeah, like Bank West is owned by Combank. Westpac owns St. George. What about Bank of Queensland? Bank of Queensland sits in the Tier 2 category. Bank of Queensland owns Virgin Money, Me Bank.
Could throw a Bendigo Bank into this one as
I was
well,
gonna
just
say
to keep it
Bendigo.
interesting.
Yeah.
So just on that idea that you've got in this example, and I'm not going to single this out, you've got Bankwest and Combank. Why wouldn't they just absorb that and make it all Tier 1 lenders?
One. It's a great question.
Well, this is, I think, not being an expert in how they bought each other or went into those negotiations, I think competition being in the marketplace and coming back to saying 76, 80% of the market of home loans is sitting with the Big Four. I would say that some of our governing regulatory bodies still want to have some competition in the marketplace. So what we find, if we unpack the Big Four a bit, there's still variances in price and policy across the 4 banks. But they're a bigger brand, and a bigger brand in the market attracts people. And with the Tier 2 lenders, there's multiple lenders with lots of different competition with policy. So the Big Four are 4 banks. The non-banks, like 30, 40, 50 lenders there competing for that last 20, 25% of the market share. So they have to compete on the policy. They have to vary the income documentation. They have to vary the pricing. They have to reduce the bells and whistles sometimes, or add the bells and whistles into their product offering to be able to attract that customer. And that's where the competition comes in. So I would say, why don't they absorb? In some cases, from a compliance and a security and all that compliance stuff, they do share information, CommBank and Bankwest, because they've got to protect from money laundering and a whole range of other things as a basic regulatory market. But they do have different policies, significantly different policies going to Bankwest or CommBank.
All right. So I just want to bring this back to obviously we understand now, like in some cases, second tier lenders are owned by first tier lenders, and just how much the first tier lenders own of the market overall. Bringing this back to someone who's getting a loan, though, if you're getting a loan and let's say you're going with a second tier or third tier lender, is there more risk in it for you? And I'll give you the example. If Bankwest was to collapse, let's just say, and your loan gets called up or something of that nature, am I, as the person who holds the mortgage, in any riskier position being with one of these lenders?
No.
Interesting.
No, straight out.
You still owe. Like I get the question all the time. If the bank I got my home loan with goes bust, do I have to pay my home loan back?
Get that question?
Yes, but that's what I've thought. I've wondered.
I've never thought that.
No.
Fair.
You still have to pay it back, because we've got very strong banks in Australia, and as there's this intermingling nature of banks and the funding lines, they understand what the risk profile of non-banks or second tier or third tier lenders are. And what we've seen in other countries is where some banks go a little bit south or bust, government or bigger banks come and swallow them up, which means you're still going to have to pay your mortgage.
Yeah.
I think it's more the implication of getting caught out, and then like maybe you were on a investment product with the bank that then no longer exists and it doesn't work for you ongoingly. Where it's like with the big four, and I never say never. There's been Lehman Brothers in the world, or the Bear Stearns things, which were some significant institutions. It's just like when you are borrowing money and you can handle that term, the idea of those terms changing adds risk to your plate in that way. So very interesting insights on that one, Aaron.
I looked at a couple of I looked at a National Australia Bank loan contract recently this morning and last night, and I looked at a non-bank contract, and there's not too many terms and conditions that are different. They still got that thing that they can vary the terms and conditions at any point in time. That's NAB. Say a Resimac, they have the same statement sitting in there. All they're looking at in any of the lending contracts is that you understand the terms and conditions, you understand the interest rate you're going to pay, the repayment you're going to make. And most of the time when we're looking at second tier lenders or even the more non-known brands, you just need to understand what we're doing and how we're going to try to move you through the process. Like most of the time with second tier lenders, most of the clients that I'm finding are there for a specific reason. They've had to use business activity statements to get an opportunity that's on the table. You look at a property, I want that property now. We are at the end of the financial year. We want to do the opportunity, and then we'll get the full documentation, tax returns and things, and then we can have a pathway back to a big bank as required. But I can also say on the reverse side is true. Once you exhaust your borrowing capacity with the big four banks and you still want to continue to invest, you've got to go to 20-25% of the market that has all the other lenders and all the other policies to be able to continue going and lending to you.
And they're hungry, right? They're really hungry. They're forced to compete.
And you can get better rates at second tier lenders. I can tell you, like if you want to compare a Bankwest and a CBA, even though they own each other, and sometimes the Bankwest interest rate's a lot less than the CBA rate, which seems strange when they own each other.
Hey, fellow business owner, if this topic and value-packed short video has resonated with you at all, and you want to dive deeper into creating wealth inside and outside your business, check out the full episode by clicking the link on your screen or in the description right now.